The eight adjustment, from where these eight adjustment are coming. So the first step for the eight adjustment from accounting profit, again, we are emphasizing from the accounting profit. This is a starting point towards the taxable income, starting point. Accounting profit, profit before tax, as per financial statement or audited financial statement, then add or less, depends upon the adjustment. The first adjustment, unrealized gain and losses, add or less unrealized gain and losses depends upon the nature of transaction. What is the actual transaction? You have the gain or you have the losses. Maybe the fair value, maybe foreign exchange. Maybe the fair value or maybe the foreign exchange. But we will see in detail. There is the other aspect that also get no impact. The next is the exempt income. So under the exempt income, the dividend participation, foreign PE, other exempt income that also to be adjusted. Then relief. What is the relief? Intra-group transfer relief, business restructuring relief, qualified intellectual property relief, deduction, add back, non-deductible expenses, restricted deduction. So this is the our point from for the detailed understanding. Deduction. But here we're going to cover all the point. Then we're going to start from the deduction. Add back non-deductible expenses, restricted expenses. And today, I believe after the end of session, you will understand where we are standing before this session and now what are the difference we have in our knowledge, or in our standing, our understanding. And after that, if we're going to read more or understand more, your accounting impact treatment and the tax treatment will be aligned. In beginning, where I mentioned the importance of the ERP or the configuration of the text module, you're going to understand. Then the related party and the connected person, transfer pricing, arm length, benefit test adjustment, based on each case, based on each scenario. If the in the corporate tax return is less than up to 500,000, the FTA do not require the detail of the connected person, salaries, benefits, or any kind of allowances. If you are exceeding, yes, then they will ask, please disclose the connected person who's getting the benefit and exceeding the 500,000 of that relevant person. So again, one of the guy in the beginning mentioned that related party. We're going to understand that related party definition. So the related party, the branch is also your related party. Okay. So the definition we're going to understand in the detail. Tax losses, utilize brought forward tax losses. We have to adjust that also. Incentive, special relief, qualifying business activity, other income expenditure not taken into account, item to be included or excluded as per the cabinet decision. Here the ministerial decision reference is also there. Taxable income or loss. After doing all this adjustment, we might be at a taxable income or tax loss. Okay, now if once we have this, now the next step here, what we are doing in the return also, the word adjusted EBITDA. This is the very important. Why we are in all the return, the adjusted EBITDA amount, the FTA is required. So then this is the common error. The adjusted EBITDA calculation is wrong. Why is wrong? Is not intentionally, because what is the complex understanding of this? Why? What are the element to be adjusted? And after that, to be adjusted EBITDA is reported. And why we are doing the adjusted EBITDA? For threshold purpose. Which are the adjustment? So to calculate the adjusted EBITDA, all these 8 adjustment to be done. If the all 8 adjustment is done, now here we mention the taxable income after 8 adjustment. What are these? These are the 8 adjustment. If we done with this 8 adjustment, then we are starting from here. Now bring down what the mean. Okay, the taxable income from main computation. Okay, so let's say we are starting from here. So now you're saying add BD net interest expenses, finance cost. If anyone want to clarify or share his point of view, most welcome. BD, net interest expenses, finance cost. If anyone want to share his point of view. BD brought down, like if under the interest capping rule, if the interest not utilized in the current year, that you can carry forward up to 10 years. So in the current year, if you have the brought down interest, that will be adjusted over here. That will be adjusted over here. Two, why we adjust over here? To calculate the adjusted EBITDA. Then depreciation and amortization. Interest on historical financial asset and liabilities. So now if you seen here, mention the adjusted EBITDA. And this is another important, the minimum zero. If you have the loss, then of course it cannot be the negative. EBITDA cannot be negative. Minimum will be zero. This is the one of the common question. They're saying, okay, if the entity have the loss, the tax loss, so how will adjust the EBITDA? If we passing all this adjustment, so loss getting higher side. If loss getting higher side, so the EBITDA cannot be less than zero. EBITDA cannot be less than zero. Then the minimum interest capping rule 12 million is remain available. Maybe the most of the companies, the finance costs yearly less than 12 million in a year. Okay, but threshold calculation, this is the mostly for the multinational corporate or the big corporate, they are having the huge financing from the banks or another financial institution is relevant for them. But on the same side, on the same point, city returns still required to compute adjusted EBITDA. So, why? Because this is the return one of the option that we have to compute and put the figure over here. If we are not familiar with the adjusted EBITDA definition, we might given the wrong figure over here. Here, it will not impact on your tax payable. The wrong computation is not impacting on tax payable as your finance cost is less than 12 million. But still, this figure that you provided may be incorrect if you are not familiar with the adjusted EBITDA, and it may lead to administrative penalties. Administrative penalties because return this figure is incorrect, and mostly people do not understand the importance of each point in the return. They just simply saying, okay, everything is the same. Anyhow, hope this point is clarified. Okay, here's a couple of exception to interest capping rule. Couple of exception. Natural person, no interest capping rule. Because we are doing this calculation, adjusted EBITDA over here, if you seen here, 30% of interest capping rule. Okay, the EBITDA we are calculating to test the 30% capping rule. But this interest capping rule is applicable on natural person? Applicable on natural person? Guys, would you please quickly reply, is applicable on natural person or no? I appreciate quick participation. What is the financial institution? Is applicable on financial institution and is return asked specifically for financial institution? So these are the exception is not most of the participant is not applicable. Not these are falling under the exception. The interest capping rule do not apply on that. And here the EBITDA negative. This is already we discussed. If EBITDA is a negative due to tax losses, okay, here the word, if we mention the tax losses, because losses, common, but here we mentioned due to tax losses, then the corporate tax point of view consolidated. Then corporate tax point of view considered EBITDA is zero because it cannot be less than zero. EBITDA cannot be less than zero. This is the very important and critical point. If you want to write down, you want to note down, please note down. It will help you to understand this whole process. And one of the corporatex learning also, and that commonly, if the people are not did the due diligence, they did not go through the tax legislation properly. They are just considering the tax is the same like what we are doing in accounting. The error chances are higher and they are leading to administrative penalties. Even you paid the correct amount, but still the administrative penalty is applicable. If any point over here, if anyone want to discuss. Okay, let's start with. Because the point where this what I'm highlighting here, adjusted EBITDA. Okay, this is the you may discuss in your circle in your accounting department may be not familiar with that, but the professional circle you may not get the appropriate answer from them also. So please understand, please look in your return also whether it's correct or not. Look in your return also, mostly done in-house or the tax consultant. See, in corporate is the concept is not that the tax consultant is doing everything, our accounting team is doing everything, our tax department, the in-house tax department doing everything. They are working as a team to ensure the legislation compliance. Even in-house team, they are also qualified tax department, but still they having the external eye to verify if any point escape, any point is missed. So this is the understanding, and the mostly people from India, Pakistan, or any other part of the world. So they taxation is already there. They familiar the taxation. What are the complication may come in the future. Yes, Rehan, GIDR, General Interest Deduction Rule. This is the mean of the this relevant to the interest deduction, this capping, interest capping. General interest deduction limitation. This is mean over that. General interest deduction limitation rule. This is the 30% of capping rule or the 12 million, whichever is higher, whichever is higher. Of course, we're going to discuss over there, but here the point is the adjusted EBITDA and the 8 adjustment. Any point in this regard? Now, the first point, the important point, again, I'm emphasizing from accounting profit, we're going to make the 8 adjustment. This is the starting point of the tax calculation. Let's move forward and see our first adjustment. The same accounting profit before tax. We are emphasizing this is the second last item. This is not the last item, that is the OCI. 8 adjustment. Let's start with the first adjustment. What is the first adjustment? Deduction. Add back non-deductible expenses. Add back. Okay, here we're gonna use that non-deductible means if we in Arabic they call the haram. If deductible they call the halal. The another term in the UK they use allowed and disallowed also. Many other terms. These terms, if we are familiar, so it will be much easier to moving forward. Why what we are doing non-deductible? It's not required to minus as per tax, not as, because business did the expense as per the accounting, as per the IFRS, as per internal accounting team. They are recording the expense. They are recording the expense, but it's not deductible from the tax perspective. Now here, if the I'm gonna refer you, if the ERP, if ERP is tax module